got the stock markets at all-time highs, yet they're going to cut rates. They've never, ever done that
Right.
before. Um, and if it were the market moving rates would generally be moving higher, just as a risk premium or risk adjustment to the fact that there is absolutely risk now in U.S. Treasuries. They were always considered, the risk-free benchmark. They're no longer risk-free.
Hey guys, my name is Danny. I'm a data scientist, and you're watching Capital Cosm. Today, I am joined by gold and silver analyst Bill Holter. Thanks for coming back on the show again, my friend.
Thanks for having me, Danny.
For sure. Well, hey, before we get started, guys, I'd like to remind you to hit that like and subscribe button. Also, check us out on Substack, capitalcosm.substack.com, to watch the full version of this interview, and also avoid the YouTube censors if we get to that point. And with all that said, let's go ahead and dive right in, Bill. I mean, it's been about 2 or 3 months since we last spoke. From a broad view perspective, like, what have you seen? What's top of radar for you right now when it comes to the markets, the economy, all of that stuff?
Oh, I wouldn't even know where to start. What's top of the radar? I mean, we're inundated with data input, whatever you want to call it. I mean, no matter what you look at, nothing's normal.
Yeah. I mean, and then you have this rate cutting cycle coming down the pike pretty soon, and it seems like it's already been priced into the markets. Gold is making new all-time highs, just over 2,600. Although I think it may have retraced back earlier this morning, but nonetheless, there's all sorts of weird things going on in the market. There seems to be something jacked up in the market. The broad market seems to be making new all-time highs, whereas things seem to be breaking down on the economic and macro front. So, what do you make of this ever-increasing precious metals price? Is it trying to signal something to us? And if so, what exactly is it?
Well, it's a mirror of the dollar. The dollar's testing on the USDX, which measures against, it's a piece of crap versus a group of pieces of crap. I mean, they're all paper. So it's paper versus paper, but the dollar is weakening versus foreign currencies. And obviously, if you want to look at you could say the price of gold is $2,600. The better way to look at it is a dollar is 1/2600th of an ounce. And at the start of the century, it was 1/300th of an ounce. So basically, it's the dollar. It's a lack of confidence in the dollar, if you will. You've got even foreign central banks are exiting dollars, and they're publicly buyers of gold. On your initial comment about rate cuts, I find it interesting that now we've already spent over $1 trillion in interest in this fiscal year. It's going to end up at 1.1, 1.2 trillion. Next year, the number is going to be higher. It's going to be 1.4 to 1.6 in that neighborhood. And that number is only going to go higher. If you look at that number versus tax receipts, it's eating up an ever-increasing large percentage of the tax revenues. So isn't it interesting that the Federal Reserve can come out and say, well, but we're lowering interest rates? When a credit gets more risky, the marketplace itself places higher interest rates on it, not lower rates, as a form of risk premium. So the Fed is doing something now that they've never, ever done before. You've got housing at all-time highs or close to it. I mean, there's sectors, obviously, that are weak in real estate, and commercial has crashed. But you've got the stock markets at all-time highs, yet they're going to cut rates. They've never, ever done that before. And if it were the market moving rates would generally be moving higher, just as a risk premium or risk adjustment to the fact that there is absolutely risk now in U.S. Treasuries. They were always considered, the risk-free benchmark. They're no longer risk-free.
Do you find it odd that we just went through the longest inversion cycle when it comes to the yield curve in history, 2.5 years or about 2 years, and the steepest one simultaneously? What does that
Right?
what does that mean exactly? Like, does that imply is the length and the steepness of the inversion curve, does that is that proportional to the outcome? I.e., the size of the recession.
Yeah, I think what is in store is the whopper of all recessions, depressions, whatever you want to call it. It is systemic. And just so your listeners understand, we have in the United States, we have never ever we've had recessions without an inverted yield curve prior, but we've never had an inverted yield curve and not gone into a recession afterwards. And generally speaking, those recessions are almost always uh, dated on a calendar once the inversion begins to uninvert. And that's where we are now. In my opinion, I think we're in a recession now. I think we've been in a recession probably for a couple of years. I mean, you could argue that we've been literally in a recession since 2008 because the financial markets, the real economy, could not have stood on its own without trillions of lending from the Fed, without trillions of deficit spending. If the economy and the markets were left to their own to either stand or fall, they would have already fallen many, many years ago. They've been on life support.
And so, what does it mean to the fact that we're cutting rates in a time where we're still dealing with this sticky inflation? I mean, they can say it's 2.5% or whatever it is, but I mean, this is just going to drive prices ballistic, isn't it?
Yeah, you would think so. That's what I was getting at when I said, never before have they cut rates with markets at all-time highs. This is an experiment uh, where I think the Fed is actually panicking because they know what's coming, and they're they're doing what they've always done. Whenever things get bad behind the scenes, they cut rates. This time you've got a facade of everything as well, but total rot behind the scenes. So I think the Federal Reserve, they played a good game by raising interest rates and backdoor shoving money into the system to try to keep things reflated. But I think it's going to be a disaster when all is said and done.
Yeah, so it seems like you have this inflationary pressure coming from the rate cuts at a time when the markets are at all-time highs, and then simultaneously you have this uber recession, let's call it, maybe even greater depression coming down the pike. So it seems like you're getting it from both ends. I mean, this is like the worst of both worlds. Is this, some hyper form of stagflation that we are looking at?
Yeah, I mean, you could use that word stagflation. I've been on the record for 10 years or more now that ultimately we would go through massive hyperinflation and massive hyperinflation of the things we need and massive hyper deflation of the things we already own, assets, in other words, the values of properties, the value of stocks, the value of bonds. And that would imply interest rates are going to go much, much higher to see a deflation in bonds. But I think that's what we're headed for. Inflation and really uh, you've already seen the inflation for the last 2 or 3, 4 years now uh, of the things we need, and you're starting to see deflation of the things we have. I mean, look at foreclosures, look at commercial real estate, look at car repossessions, look at uh, defaults on credit cards. Those are all deflationary.
Now I know no one has a crystal ball, but if you had to put a dollar on this stuff, and I'm sure you put more than a dollar, trying to in the market. But if you had to bet, what would be the ticking time bomb the one catalyst that sets it all up? And in 08 it was the housing crisis, right? What do you think this time will be?
I think we already started to see it last month with the yen carry trade
Mm.
starting to unwind. And I mean, just because of the size of it, and also the fact that you can't look at it you can't look at derivatives and logically see what the total is, who's trading with who, where the weak points are. I'm just going to say broadly, this blow up is going to be derivatives. And Warren Buffett calls them weapons of mass financial destruction. That's exactly what they are.
And what's the volume of these derivatives? Is it in the quadrillions, or some crazy number like that?
Yeah, it appears that we're told that back in 2008 that it was overestimated when it was 1.4 quadrillion, and the real number was only 600 quadrillion. And we're told that that number is still the same, which is complete bullshit. There's no way. I mean, to see a reflation in the system without derivatives expanding, that's a ridiculous argument. The real numbers, in my opinion, somewhere north of $2 quadrillion. And understand that 1 quadrillion is more than all the assets on planet Earth.
Yeah.
So it's truly the tail wagging the dog.
So $2 quadrillion, essentially 2,000 trillion dollars.
Exactly.
I mean, what happens, when this bubble? I mean, this is like the bubble of all bubbles, right? Our entire society is essentially just
Right.
anchored to that.
Well, I think in a nutshell, I mean, we could talk on this subject alone probably for 2 hours or more. But I think in a nutshell, what it means is credit is going to cease because confidence is going to break, and credit will not be put forth without confidence. And understand that the real economy today entirely runs on credit. Everything you do, uh, you flip a light switch, you turn your water on, you go to the grocery store, you buy gasoline. Whatever you do, there's credit involved, and without credit, there's nothing functions. That's what's going to happen. Is the real economy is basically going to cease to exist for a spell, 2 weeks, 2 months, God forbid 6 months or more, because you will see people die from lack of food. But once credit ceases, the real economy is going to basically stop.
And for those who may not know, what is a derivative exactly? And how did we get to $2 quadrillion worth of derivatives?
Well, originally, derivatives, uh, I guess the original derivatives were futures contracts on commodities. You had a corn farmer or wheat farmer, rice farmer, whatever, uh, selling to hedge their production, and you had speculators on the other side. Uh, Not always on the other side. Speculators would either buy thinking the price is going to go up, or sell thinking the price was going to go down. So those are the original derivatives for basically the commodities markets.
Mm-hmm.
Then in 1976, uh, we they started in Chicago with options, and then you had futures on stocks, futures on bonds, futures on everything. And in today's world, there's futures on air quality, there's futures on temperature, there's futures on everything. Basically, there's bets both ways on everything, and it is a zero sum game. So in a single contract, there's a winner and there's a loser. And the problem is when the loser loses so big that they go bankrupt, then the winner becomes a loser because he's not getting paid. And that's where everything paper becomes worth nothing.
And so when, like for example, when you look at like the sovereign debt, we can anticipate and say the bubble on the sovereign debt pops when no one buys our debt. As long as there's someone out there buying our debt can be 200% debt to GDP ratio. As long as there's a fool out there to buy our debt. But once that buying stops, that's when you're going to see that sovereign debt collapse. We can touch on that in a second if you want, but I want to tie it into the derivatives. Similarly, how do you know when enough is enough? Is you say we went from 1 quadrillion to 2 quadrillion, be that as it may. When do we know that we've hit the event horizon that we just can't sustain any longer?
Well, the markets will tell you that someone will blow up, someone really big will blow up.
Mm-hmm.
Um, Understand that derivatives ultimately became a weapon, if you will, that governments worldwide and big trading houses worldwide have used to price assets. If something was too high, they would they would use derivatives. I mean, even governments themselves, central banks themselves, would use derivatives to sell the price down. And you've seen that for many, many years in gold. You've seen it in silver. You saw it. Uh, Perfect example. You saw it on uh, October 20th, 1987. They couldn't get the markets open that Tuesday morning. The way they got the markets open, there was one futures exchange that was trading. It got open, but there was almost no volume, and a
Mm.
grand whopping total of $6 million with an M. I mean, pocket change today. $6 million was used to buy the value line futures, which sparked, I don't know, the equivalent of a 50 to 150 point rally in the Dow. And then slowly but surely things started opening. And the day turned up, I think it was after 2 or 2.5 hours, they finally got markets open and the market was up 150 points or whatever for the day. What I'm getting at is they can prop markets up by using derivatives. They can also retard markets by selling the derivatives. Like I said, with gold and silver, I mean, that's for years and years. Um, they've dumped paper contracts to the point where now with silver, you're probably looking at somewhere in the neighborhood of 300 paper ounces are sold short for every 1 real ounce that exists. So is the proper price of silver $31 an ounce? Probably not. It's probably many, many multiples of that once those shorts are forced to cover, or if they're not forced to cover and the exchange just ceases to exist, then there's your great reset. You will find asset prices will reprice based on cash and carry, cash and carry pricing.
Yeah, and when you look into some of the works of these people, behind the Great Reset, these central bankers, etc., they talk about things like the financialization of natural resources, like the rock behind in your backyard, the tree, sitting there, like so they're trying to financialize as much of the earth as possible to in anticipation for what could be a massive collapse, whether it be in the derivatives bubble or some other bubble out there. They're trying to scrape as much as they can from the bottom of the barrel. This is why I think you have these sudden talks about taxing unrealized gains. So they see the system collapsing, and they're just trying to get as much out of. They're just trying to squeeze as much out of the common man, the citizens as they can.
Right. And that's from the standpoint of the great taking. They
Mm.
want to take everything. Um, a different viewpoint on that financialization of everything is they're being forced to do that because there's no collateral
Mm-hmm.
left. There's no unencumbered collateral that they can borrow against. So they're making things up that they can pledge as collateral because in any Ponzi scheme, if the new money coming in, well, i.e., uh, new debt, without new money coming in or new debt being borrowed, the scheme collapses. And that's where we are right now. We're at the point where there's no collateral left to borrow against. There's no cash flow left to borrow against that hasn't already been borrowed against. So we've reached the debt saturation level, and the collapse of the Ponzi scheme, we're right there.
Yeah. So how does gold and silver fit into all of this though? You see these central banks in the east, they're buying up gold, but you don't see many reports of Western central banks buying up gold. They may, but I haven't come across any of those reports. Number one, is that true? Number two, why do you think the central banks here on our side of the sphere uh, are just don't care to accumulate their gold?
Well, first, Western central banks, you have to understand that gold is the anti-dollar. So
Mm.
the Western central banks don't want to give any credibility to gold because it is a competitor, the the direct competitor versus paper fiat currencies. Uh, they want to show you that gold is bad, dollars, yen, euros, etc. are good. Uh, as far as uh, as far as gold and silver, where do they fit in? They are money themselves. They are the original money. They're God's money. They are what dollars originally were derivatives of, what pounds originally were derivatives of. Think about currencies. You've got the lira, the peso, the pesada, the pound, the dollar. What do all those terms have in common? They all are a weight system. They have something to do with weight, and that weight was of silver, or that weight was of gold. And those paper currencies were originally derivatives of gold and silver. But gold and silver are the original monies. And they were the original monies because there's no liability, there's no counterparty risk, and they cannot be printed, they cannot be debased. Whereas the paper currencies created by man, they can be freely printed, freely diluted, and they have been because you can't trust man.
Yeah, now you have these BRICS countries. They're talking about a 40% gold standard on whatever settlement currency they come up with. What will that? I mean, that sounds like that could completely demolish the dollar. You have a competitor that's actually backed by something tangible. Wouldn't capital just flee from the dollar into whatever that is if that was the case?
Well, I guess the best way to answer your question is with a question. If you had a choice of saving in a currency issued by a insolvent issuer versus saving in a currency that's backed 20%, 40%, whatever, by gold, it's got, say, oil, other commodities, something real, which would you put your money into?
Yeah,
And
it's a
would
no
you bet
brainer.
on the insolvent issuer? Yeah, it's a no brainer. Um, so, yeah, it will absolutely smoke the West. And it's also going to create a huge trade problem because, I mean, here in the United States, we don't make anything anymore. So if you've got foreigners saying, we don't trust the dollar, we don't want the dollar, we'll trade with you, but we want to trade something real for something real, what you've just done is created a huge supply deficit of goods. And what it's going to look like is a massive hyperinflation of anything and everything consumable by people in the US, by the West. So it's going to smoke the entire Western financial system. And I do want to just clear up because some people have said that I'm the one who came up with 40% backing. I think what they said was it'll be between 20 and 40% gold backing.
Gotcha.
Maybe it's going to only be 10 or 15%. I don't know. I have no idea. Um, I think to me, it sounds more likely at, 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 at current thought, it seems more likely to be closer to 20 than 40. Um, but if it's 20, if it's 40, uh, the gold price may have to go up only fivefold or eightfold. But if it's 20%, now you're talking about gold's going to have to go up tenfold, 15, 20-fold because it has to be big enough to back trade.
Oh,
And at current prices, it's dwarfed by trade.
so hold on. So if it's a higher allocation of that backing, then gold would move at a smaller rate.
Right, right, because it's already at a higher, it's already 40% is double 20%. So if they choose 40%, then gold only needs to be revalued
Oh, okay, yeah,
half as high as if they choose
right.
20%.
Yeah, that makes sense. What if silver? What happens to silver in that scenario?
Well, silver, obviously is going to be, I mean, it's a cousin or sister or whatever you want to call it of gold. It is money, but it's also used uh, for industrial, technological, medicinal. There's so many uses. The allure, first off, the ratio at 85 to 1 is stupid. It comes out of the ground at 10 to 1. It traded at 16 to 1 for hundreds of years. And the reason it was discounted from 10 to 1 to 16 was because you've got to transport 10 times the amount. So man discounted silver. Um, but understand there's no big stockpiles anywhere on the planet of silver. Gold's another story. You've got central banks all over the world that have hoarded gold. So you do have large stockpiles of gold. Pretty much all of the silver that's ever been mined has already been used. I mean, there's no central bank that's sitting on, you know, 1,000 tons or 5 or 10 or 20,000 tons of silver. That doesn't exist because when silver gets mined, I think the number is something like 20% or thereabouts goes to jewelry. Then the rest is used through solar, through use in computers, phones, cars, all kinds of technology. There's medicinal uses for it. It's the best conductor on the planet. I think people are going to find out that silver, when all is said and done, is going to be gold on steroids as far as purchasing power is concerned. Now, there are some that believe silver is going to become more valuable than gold. I don't see that at all because like I said, it's mined 10 to 1. It comes out of the earth 10 to 1 rough. So I don't see any way that silver is going to become more valuable than gold. I think that's a complete pipe dream.
Right, but even if you take it back to the 10 to 1 ratio, I mean, you're still looking at 250, $260 silver, which is a
Correct.
significant change.
Right. Yeah, I mean, I think it's more likely, or to see 40 to 1, that would give you $65 silver with gold where it is now.
Hmm. Right.
Gold wouldn't move and silver would double.
What do you think the odds are that as things continue to unwind, the West becomes more insolvent? Do you think there's a possibility that they start confiscating precious metals at some point?
I don't think that silver will be confiscated. It it may become very difficult to buy as a retail person. There may not be that supply, but there's no big hoards, above ground hoards to confiscate. Um, Gold is another story. Gold has been held for years and years and years. You've got central banks, obviously, that own gold. I think gold is much more likely to be looked at from a confiscation standpoint. Where I really think what they're going to do is they will more than likely, and right now the safest or the perceived safest uh, geographical areas to own a gold mine is North America. And in my opinion, it's probably the riskiest place because I could easily see the United States and Canada nationalizing gold mines because they've got to build up a gold stockpile to try to be able to uh, start to trade again. They've got to build up a hoard of gold. I mean, the 8,300 tons that are supposedly held at Fort Knox and West Point and the other depositories, that's a that's fictional. There's not been an audit since the 1950s. So, assuming we're starting at 500 tons or 1,000 tons or whatever, how's the best way to fill up your coffers? Nationalize the mines.
And so let's go ahead and pivot over to the gold and silver stocks. What's your sentiment on those? Given the fact that gold and silver have risen pretty well, but the stocks have really kind of lagged behind.
Yeah, I think when all is said and done, the mining industry worldwide will probably make stock market history.
Hmm.
They'll make Apple, Nvidia, the Magnificent Seven or whatever. They're going to make them look like kindergarten parties. I think the because gold and silver are going to go to such numbers, and the operating leverage on these mining companies is going to be huge. I think you're going to see uh, something that makes 1980 dwarfed. 1980, uh, there was not one gold mining company anywhere in the world trading under $1 at the beginning of 1980. So, maybe this time there won't be one trading under $10. Who knows? The point being, I believe when all is said and done, the mining sector will have made stock market history if you're in the proper geographical areas. As I mentioned, I personally think that the real risk is in North America, which right now is perceived as the safest haven.
I see. Any other big opportunities that you see that eclipse the gold and silver sector?
Now, no, this is all, the whole thing is about credit. Credit's going to break down, which all the cash on the planet is fiat, which means it's credit based. And when credit cracks and the currencies crack, then where are people going to put their money as a safe haven?
Yeah.
I mean, if U.S. Treasuries are not considered uh, safe, if European bonds are not safe, if sovereign bonds across the globe are not safe, where are these trillions upon trillions of dollars going to go to? Are they going to go to gold? And I don't even know what the number is,
Yeah.
but it's probably 10, I don't know, $10 trillion has been mined, something like that. And in silver, what's a tenth of that? $1 trillion total. And you've got hundreds and hundreds of trillions of dollars trying to move to safety. What's it going to do to the price? What's it going to do to the supply? Supply will go into hiding. People will say, absolutely not. There's no way I'm selling 1 ounce of gold or 1 ounce of silver for a piece of paper because I'm giving it away for free.
Yeah. If you look at like the gold to S&P ratio, for example, I mean, it hasn't been this low. I mean, it's at a very it's either at a very maximal low and at an absolute low, or it's right up there. So the ratio between buying the S&P and buying gold, I mean, you can buy a ton of gold with a share of an S&P or a unit of S&P. Um, do you think this capital rotation is underway right now, or do we still
Yeah,
have a little
absolutely.
bit of runway to
I think
go?
it's already turned. I think it's already turned. You're definitely seeing the stock market, grossly overvalued and struggling to make new highs with gold. What's gold up so far this year? 40% or something
Hmm.
like that. So that turn is already, that inflection point is in the rearview mirror. It's not perspective. It's already started to happen.
Yeah. And how long do you think it takes to play out? I mean, these things, like if you, there were episodes of where we saw this occur, like in 2000 all the way up to 2012. and then like the 80s. So where do you think this fits in terms of magnitude of reversals?
I'm just going to say that all bets are off because what has happened in history, we had a system that held together.
Mm.
This time around, the system's not going to hold together. In my guesstimation, I firmly believe when this thing breaks, it will likely be three spins of the globe, a 72-hour event, and they won't be able to get markets open. If you can't get markets open, but you could trade an ounce of gold for Lord knows, what number, but that number is going to be much higher than it is now. What does that chart look like? You might have blown the top off the chart in 72 hours. So I'm not going to say, yeah, this is going to be a 3-year run or 5-year, 11-year run like the early 2000s. This could be a 72-hour event.
Wow. And so when we look at how things are playing out, do we see this as a global event or is it isolated to the West?
Oh, this is global and this is worldwide. But understand that the East, because they've been accumulating gold, they're going to have a cushion because the gold component is going to expand by a huge amount and maybe even more than by what they lose. It's possible with China's gold holdings that the gold rises and dwarfs the losses that they have in U.S. treasuries. And understand that the West has borrowed money for all these years, but we've eaten off of that. We've eaten our seed corn. Whereas China borrowed money, but what did they do? They built cities, they built railroads, they built airports, they built infrastructure. So if they walk away from their debt, they're left with something. When debt implodes in the West, well, it's game over.
Yeah, it's not going to be pretty. That's for sure. What's your biggest concern right now, Bill? Out of everything out there.
Um, I think my biggest concern is the rule of law. I mean, mathematically, this thing is going to go down. And how does it go down? Does it go down under the actual, the statutory rule of law, or does it go down under the rule of law as they say the rule of law is, and it changes every day to benefit them and to put the boot on the average person's throat even further? So I think, it, I guess, I guess it boils down to good versus evil.
Mm. So, in what way? With this rising totalitarianism?
Well, yeah, absolutely. I mean, the plan is to turn the human population into slaves. They're completely controlled, completely monitored. Uh, if you don't go along with their narrative or their opinion, you're a dissident, and they want to shut you off. You can't have food. You're going to die.
And do you think
So
this?
yes, total totalitarianism.
Mm-hmm. And do you think this will again? Will this be like a global plan, or given the fact that you're
Yes.
seeing a fight between East and West, that it might be a little too hard to create a global allocation. You might have two world orders as opposed to one global government.
Yeah. And there will be fragments off of that, but the bottom line is whoever's in control. Let's say that it's 3 or 4 different factions. They could sit in a room and all decide the insect of the month is going to be grasshoppers or whatever.
Yeah, it's kind of like a cartel at that point.
Right.
Well, hey, Bill, where can people find you?
You can go to my website. It's simply billholter.com. There is a contact button. I do work as a precious metals broker. If you want to contact me directly, my email is bholter@proton.me.
Sounds good. Well, all right. Well, thanks for tuning in, guys. If you appreciate it and like this interview, be sure to give us a like, subscribe to the channel if you haven't already, and also check out our Substack for the full interview experience. For the stuff that we may not want to post on YouTube, be sure to check out the Substack for that. You had to hold either gold or silver for the next 5 to 10 years, and you couldn't trade in or out, swap the two. If you could only hold one, gold or silver, for the next 10 years, what would it be?
I guess before I answer that,